Welcome to Market Catalyst. I'm Allie Canal. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, President Trump looks to oust Fed Governor Lisa Cook. We break down the market implications and the historic legal battle ahead. Plus, we'll discuss the latest on trade as President Trump threatens higher tariffs on China and on countries imposing digital taxes. Plus, all eyes on Nvidia. Its results are set to be the next big test for investors in the AI trade. We'll break it all down on Market Catalysts. Let's get a check of the markets here. You're seeing that the S&P 500 has now flipped into the green. We just ever so slightly here, still mostly trading flat. The Dow also trading flat, oscillating between above the flat line, below the flat line, and the NASDAQ composite, the biggest laggard of the session, but again, essentially flat at this point as investors continue to digest this latest news from President Trump. We're also seeing some sort of a reaction in the bond market, but really not too much. You're seeing yields tick up ever so slightly. The 10-year yield is still hovering below 4.3%, and the 30-year yield is right around that 4.9% level. But President Trump escalated his fight against the Federal Reserve by announcing he would fire Lisa Cook from the Fed Board of Governors. The Fed governor said she has no intention of resigning, adding that the president has no authority to fire her. For more on what this potential ousting means for the future of the Federal Reserve's independence, John C. Coffey, director of the Center on Corporate Governance at Columbia Law School, joins us now. John, thanks for being here. What is your reaction to Cook's response that the president has no authority to fire her?
Well, look, I think we're going to see a major constitutional.
I don't hear it.
You ready?
John?
Yes.
Sorry, we just lost you there for a second, but I did want to get your reaction to Cook's statement and where you think things go from here.
Well, I think the president wrote a letter that says he's relying on the fact that there is legal cause to remove her. He doesn't have the evidence himself. He got only a report from a political appointee who may be saying what the president wants. I think there's going to have to be some kind of hearing. Before you decide someone can be fired for cause, there's got to be some chance to defend yourself, to present evidence, to see what's being argued against you and test whether or not it really is adequate. So far, we know only that she is alleged to have listed herself as the primary owner, the primary person who will reside at two different houses fairly close together. That's possibly inaccurate, but I'm not sure that it's a material violation that injured anyone, and that'll have to be tested. She has a very well-respected white-collar criminal attorney representing her, and I think there will have to be some kind of hearing, which a court will have to establish before you can determine if there was legal cause. You just can't assume it because someone writes a letter to the president.
So, and I'm also curious because the alleged mortgage fraud, that occurred before her term. So does for cause still apply here?
Well, cause means some substantial piece of evidence that should disqualify you. If you knowingly tell lies to get an improper advantage, I can say that would be a cause. I don't know who filled out these applications. I don't know if she knew that she was listing herself as the primary resident for two different houses at about the same time. We've got to get to the bottom of what was said and what was intended and whether it had any real impact upon the Federal Reserve or on her reputation for honesty. I think the Trump case will be essentially that a person who is the governor of the Federal Reserve has to be totally honest, and we can't tolerate any untruth. If that standard had been used for him earlier on, he might have had a serious problem in his own criminal cases. But it's going to be an issue first about whether there was legal cause. Ultimately, this could also be a constitutional issue because there is one school of thought by very conservative constitutional lawyers that the president has absolute power to remove those people he appoints, that he gets it from the Constitution.
Now, if Trump were to succeed here, does this effectively open the door when it comes to presidents being able to fire Fed governors? And what could that mean for the future of Fed independence?
Oh, I think this would really threaten the Federal Reserve. He didn't go after the chairman because he saw already that would cause a major stock market reaction. I'm not sure that her removal will get the same stock market reaction, but it would give him a majority on that board of Trump appointees, and he would have the ability to effectively force through lower interest rates, thereby curtailing the essential purpose of the Federal Reserve. Federal Reserve is there to set monetary policy independent of short-term political considerations. And if you can't do that, you're likely to get long-term inflation. So I think there is real grounds for being concerned that the integrity of the Federal Reserve and its independence will be at stake if you can remove people this easily. Remember, she was appointed to a term that ends in 2038, more than a dozen years from today. That meant it was assumed that she was going to be a long-term person who could acquire independence and not have to be beholden to the president. Uh, if she could be fired for what might be minor transgressions, I think that undercuts the idea of independence. Nonetheless, we have to have a hearing to find out what the evidence really is and what the justifications were on both sides.
So is that the immediate next step here, John? You go and have a hearing, and I've been reading a lot about how this could make its way to the Supreme Court. How likely is it that we could see that?
Well, it's already gone, this issue has already gone to the Supreme Court in the last year. And they said in the case of other traditional federal agencies, like the FCC or the Federal Trade Commission, that the president does have the power to remove. The Constitution gives him that power because it says all executive authority is vested in the president, which can be read to mean he's got the right to remove anyone who is not in a special position like a federal judge. Nonetheless, that same decision said the Federal Reserve is different, that the Federal Reserve is not a traditional federal agency. It is, after all, a bank. And a bank didn't derive its powers from the president. It derived its powers from the nature of banking and from congressional legislation. That makes them quite different than a law enforcement agency like the FTC or the SEC or the FBI, where probably the president today can remove the people who are appointed to those offices. This has been a relatively new area of Supreme Court decision making, but they have curtailed the ability to stay in office of appointees. But they have also said the Federal Reserve might be different because it's fundamentally not an agency of the president, but a bank trying to maintain a stable monetary policy.
John, thank you so much. Really appreciate those insights.
Okay.
Well, consumer confidence fell slightly in August to 97.4 compared to 98.7 in July, and expectations of a slightly larger decrease. It's the latest read on the consumer as Fed Chair Powell signaled rate cuts could be on the table as soon as the September meeting. I want to bring in Yelena Shulyatyeva, the Conference Board senior U.S. economist. So, Yelena, what do you make of this latest read on consumer confidence? Seems to be a little changed in August.
Yeah, there's a very small change, and essentially, confidence remains at the level we have seen over the last 3 months or so, which is below the low levels over the last couple of years. So confidence is weaker these days, but it's not necessarily signaling something, dramatic is coming. So one area of concern remains the consumer's assessment of the labor market. So we have seen the 8th consecutive decline in so-called labor differential index, which measures consumers' assessment of jobs availability. So this is a risk, but it's not necessarily pointing to some dramatic moves in the labor market, and the differential remains positive. But nonetheless, it's definitely something we are watching very closely.
And I'm also looking at the expectation index. This tracks consumers' short-term outlook for income, business, labor market conditions, like you were just saying. That did fall in August. It's at 74.8. Historically, a reading below 80 indicates that a recession is coming, but we've been at these levels for quite a bit now. Do you think that a recession's on the horizon here?
No, we are not expecting a recession, and there are a few key reasons for that. So we do expect a significant slowdown in the second half of the year in economic activity and going into 2026. The consumer fundamentals remain strong. Okay, so you could see that we have delivered quite significantly since the global financial crisis in the early 2000s. Consumers' balance sheets remain much, much stronger than that. So consumers have a lot of capacity to withstand higher inflation coming from tariffs. And I think that's the key point here. For a recession to come, we need to see some significant crisis, which is probably not on the horizon. The Fed remains, ready to act if necessary. And, lowering interest rates this year would help consumers at a margin, I think. So I think, yeah, the economy is slowing and consumers are feeling that. They are explicitly talking about tariffs, creating inflationary pressures as well in the survey. But I think the situation is far from being very critical at this point.
So do you think consumers are now moving beyond tariffs and focusing more on the broader economy, like the labor market, which is similar to what we heard from Fed Chair Jerome Powell last week?
According to the conference board survey, consumers are still very much focused on the tariffs. So maybe, as the news cycle goes, maybe we're more clear about what happens to tariffs. They're here to stay. But for consumers, going to, shop for back to school and things like that, it's still very much alive. And I think consumers are very much concerned about tariffs and inflation in particular.
Now, Yelena, we're talking consumer confidence on a day where many Americans may be questioning the stability of the Fed. How do you think Main Street is digesting the latest headlines around Lisa Cook's potential ousting?
Well, I don't think the Main Street is really very much concerned. The markets even are not reacting dramatically to this. Market participants are even quite unsure of what happens next. We don't know if she's fired. We don't know how that process will evolve. Will she show up to work, and what happens next? It will probably end up being in the courts, and it's going to be a lengthy process. So what matters for consumers is if inflation and inflation expectations get unanchored as a result of all of this attacks on Fed independence. But it's a longer term process, and I don't think it's an immediate concern for an average consumer.
Now, going back to the survey that we saw in August, what stood out to me is among demographic groups, confidence fell for consumers under 35 years old. What's driving that? And my immediate mindset went to the housing market and how a lot of millennials are not able to purchase homes at this point.
Well, there are a lot of different headwinds happening for this particular age group. Jobs availability is probably one of the most significant concerns for younger adults, as AI is replacing some of the entry-level positions. So, if you look at the recent payrolls reports, it's really the unemployment rate increase since the trough back in 2023 has been driven by inability of people to find a job, not necessarily the recent layoffs. And this is a major concern for younger adults. So as you mentioned, the housing market remains quite unavailable for those individuals. And, if we see rates rise in the longer portion of the yield curve, that could also continue to put downward pressure on the housing market. So I'm not surprised that this particular age group is very concerned about economic developments.
I will be continuing to track how the consumer is feeling. Yelena, thank you so much. Appreciate it.
My pleasure.
All your markets action ahead. Stay tuned. You're watching Market Catalysts. President Trump threatening an already fraught trade truce with China, saying he will impose up to 200% tariffs on Chinese imports if rare earth metals exports are curbed. Trump claiming leverage over Beijing, which has a tight grip on rare earths, saying to reporters on Monday, quote, 200 of their planes were unable to fly because we were not giving them Boeing parts purposely because they weren't giving us magnets. Joining us now to discuss is Wendy Cutler, Asia Society Policy Institute Senior Vice President. Wendy, Trump says the U.S. has a stronger hand because of airplane parts, but China controls 90% of those rare earths. In reality, who has the upper hand in these negotiations?
Well, again, both sides have leverage. Clearly, the U.S. learned the hard way that China will withhold magnets and critical minerals if there is a trade war. We need those materials. China supplies 70 to 90% of most of the critical minerals. I think our president's very frustrated with the fact that a trading partner may have more leverage than we do. And so therefore, he's threatening high tariffs. But let's keep in mind, the last time he threatened these high tariffs and they were put in place, he removed them within days, given the impact on the U.S. economy, including the bond market. So I'm a little skeptical that he will go forward with this threat, particularly at a time when he seems to be very interested in meeting Xi Jinping and visiting China.
And now China is sending its top trade negotiator to Washington this week as talks continue between the two countries. What should we expect from these meetings, and how seriously does Beijing take this new tariff threat?
Mm-hmm. Look, in terms of these meetings, I'm assuming they're about laying the groundwork for a potential Trump visit to China. But the Chinese have made it very clear that they're not interested in putting their leader in a meeting with our leader unless significant progress is made on a trade deal. They don't want any surprises or any uncertainty. And frankly, the threat today from the president on critical minerals, I'm sure, is being looked at in Beijing with a lot of disappointment, and frankly may lead them to reassess whether a meeting is even in their interest, given these threats.
Well, let's turn to South Korea, because Seoul just announced $150 billion in new U.S. investments. That includes a $50 billion aircraft order from Korean Air. But this came alongside a compromise to avoid 25% tariffs, with the 15% tariff rate still in place. So how significant are these deals, and how durable do you think is that compromise?
Mm-hmm. Look, I think the announcements of a new investment fund by Korea, new foreign direct investment by their companies, new purchases of energy and other products from the United States are all welcome. The concern, however, is none of this is written down, right? And both sides, particularly with respect to the $350 billion investment fund that they announced at the end of July, both sides have different interpretations of what this actually means in terms of its structure and its administration. And so, again, these numbers are welcomed. Our president loves these big numbers to show that he's turning around the trade deficit. But again, I think there are going to be bumps in the road going forward.
Now, Trump is also threatening tariffs on countries that tax U.S. tech, and South Korea does. What does that mean for this new deal, and could it undermine the investment momentum that we've seen?
Exactly. And not only with Korea, but look at Europe, where we just announced a joint statement. And, in those negotiations, the U.S. had pressed for movement from Europe on the digital front. Europe resisted some of our requests. And so the notion we announce a deal with them and then a week later we're threatening them with new tariffs, I think this is going to lead to a lot of unease among all of our trading partners trying to kind of deal with this uncertainty and unpredictability.
Now, let's turn to India, because New Delhi faces 50% tariffs starting this week over its Russian oil purchases. Do you expect those to actually take effect, or is there room maybe for another delay?
I had hoped that there would be an opportunity, at least not to put on that additional 25% tariff, which is scheduled to go into effect tomorrow. However, the orders have gone out to our customs authorities to impose these tariffs. So I'm pretty pessimistic. I think they will go into effect, and the question will be, can the two sides get together and find a way forward? I mean, this is such an important bilateral relationship. And the notion that we're putting some of the highest tariffs on India versus any other country is really hard to understand.
And we did hear from India's ambassador saying that the country will keep buying oil wherever it gets the best deal. So does that signal that India is really digging in here regardless of that U.S. pressure?
Absolutely. I think India is digging in, and I don't think it's any coincidence that Modi is looking to Putin and to Xi now with a little more, with more open arms than he's had in the past. I think that India is going to do what it needs to do to reduce its dependence on the United States and to build ties with other countries as quickly and as deeply as they can.
Lots of deals and potential deals to keep track of. Wendy, appreciate it. Thank you so much.
Thank you.
All your markets action ahead. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We are live at the NASDAQ. Let's get a quick check of the latest market action. We're about 1 hour into today's trading session, and we're seeing this reversal across the S&P 500 and the NASDAQ to the upside. The Dow still flat as we make our way into today's trading session. At 10 o'clock, we got consumer confidence out from the conference board that showed that consumer confidence was little changed in the month of August. And that's largely when we saw all three major indices move to the upside. Also worth noting here that this has been a pretty muted reaction after President Trump called on Truth Social that he was going to fire Fed Governor Lisa Cook. We're getting some notes out this morning from UBS saying in particular that, what's really happening here due to this muted reaction is that there's limited conviction on the street of whether or not President Trump actually has the legal grounds to follow through. We also know that Trump has repeatedly threatened to dismiss Fed Chair Jerome Powell, and largely now markets sort of taking this all into consideration and not really reacting too much. But I do want to point out Ethereum and Bitcoin because we are seeing moves there. Bitcoin, after a larger sell-off that we saw on Monday during that trading session, we are seeing Ethereum and Bitcoin move lower this morning. And I also want to get a key read on Nvidia. Nvidia makes up about 8% of the S&P 500, and we are expecting their earnings report on Wednesday after market close. We also, Yahoo Finance is speaking with CEO Jensen Huang, and there are major implications heading into this report. Month over month, compared to a month ago, that stock is up more than 4%. And year to date, this has had quite the run. Nvidia stock is now up nearly 35% year to date and up more than 40% from a year ago. We'll be keeping a close eye on Nvidia and all other semis and AI as we make our way into Wednesday's market trading session. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's trending tickers. We're watching the New York Times, Trump Media, and Olaplex. First up, the New York Times. The financiers that led a high-profile activist campaign at the New York Times 3 years ago have now taken a stake in the newspaper company through their new investment firm. FiveSpan has built a position in the Times and is pushing it to use artificial intelligence to expand its subscription base. That's according to Bloomberg reporting. Next, Trump Digital. The company, along with Crypto.com, have agreed to a deal with blank check vehicle Yorkville Acquisition to create a crypto treasury company focused on buying and holding CRO tokens. That's the native cryptocurrency of the Kronos ecosystem. The treasury company will become one of the latest to follow the playbook Michael Saylor created at Strategy, raising funds to buy and hold crypto. Shares held by Trump Media, Crypto.com, and Yorkville will be subject to a mandatory 1-year initial lockup period that follows the closing of the deal. Finally, Olaplex, the hair care company announcing it's buying beauty-focused biotech company PureValla. The purchase will be the company's first ever acquisition. PureValla Biosciences was founded in 2020 by Dr. Bradley Olson, a professor of chemical engineering at MIT, to develop beauty ingredients and products. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. All your markets action ahead. Stay tuned. You're watching Market Catalysts.
I'm joined now, got Tom Narayan, lead equity analyst of global autos at RBC Capital Markets. Tom, it is great to see you. So when we talk, Tom, about the EV slowdown, we'll talk about different factors, maybe it's politics or range worries, but you're focusing on a different variable, Tom, which is used prices for EVs. Walk us through it. What are you seeing there?
Yeah, it's interesting how this, I think, is being forgotten a lot by the market and the media. In some cases, there's a lot of focus on culture wars and range anxiety that gets a lot of attention. But when you really look at what's driving the EV slowdown, we think it has to do with used EV pricing being so much below new EV pricing. So much so, as you pointed out on that chart, it's like a 45% discount. If you can get a Tesla Model Y for $13,000, why would you buy one for 50, right? Whereas on the ICE side, right, internal combustion engine side, the discount between new and used is only about 25%. So what we're noticing is really, and we're seeing it in the data, if you look at California vehicle sales in 2024, the new EVs fell off in 24 versus 23, but used just absolutely spiked. So much so that you can't ignore that type of data. It's clear that what people are doing is they're seeing the deals that you can get on used EVs, and they're buying the used EVs instead of the new EVs.
So let me ask you, if that's the trend, then as investors, how do we want to be positioned to play that theme? Who are some of the winners you would call out from it?
Yeah, we think that what this trend means is that this EV slowdown has legs. It will likely continue, right? Because you're going to have new EV prices go up because of tariffs and whatnot. Also, you had a lot of people on leases, right? They leased an EV back in like 2022 post-pandemic. Now it's 2025, 3 years have gone by, and it's time to return that car, and they're buying a used EV instead of a new EV. So we think this continues. Who do we like? We like the legacy OEMs, that's like Ford and GM, who can sell internal combustion engine cars. We like those guys. We also like auto suppliers that are tied to those legacy OEMs, suppliers that are tied to Ford and GM. Who are we worried about? It's the pure play EV guys, maybe your Rivians, your Lucids, to a lesser extent Tesla, although we think that stock trades on other things. But really you want to own, I think, names that benefit from internal combustion engine sales, and less so on companies that are completely dependent on EV sales.
But correct me if I'm wrong, Tom, GM and Ford, I thought you had an outperform on GM and a sector perform on Ford. Is that still the case? And if so, how come?
Yeah, that's true. And that's a lot of that just has to do with kind of comparing the two against each other. We do like GM more than Ford right now for a number of reasons. But the thesis on Ford, we're kind of warming up a little bit to it, honestly. And a lot of it has to do with this dynamic itself, the fact that the EV slowdown continues. Now they don't have to sell as many EVs, they can sell more large SUVs and pickup trucks, which are cash machines. So if that continues, we could change our view on Ford potentially. Right now, it's just more of a relative bias towards GM right now, but that's definitely warming up.
And you also talked, Tom, there, I heard you mention the names you thought, okay, that could be disadvantaged by this EV slowdown, and you mentioned some of those pure play EV names, the Lucid, the Rivians, but I know you still like Tesla. Why do you still like Tesla here, Tom? Is that the new affordable model on the way in Q4? Is it the robo-taxi play? Explain it to us.
Yeah, I think this one has less to do with cars at all, right? And it's very much to do with the robo-taxi. Also, you know what's been really I'm getting calls on a lot lately is humanoid robots. If you asked me this, I think you did ask me this maybe a few months ago, I would have been like, I don't know, I need to do some work on it. But the more I'm reading on it, the more the market seems to be warming up to obviously AI and on this humanoid robot topic. This has some legs too. So I think the reason why I like Tesla is I do think there's a lot of growth here in non-cars. So while I am worried for them on car sales because of the EV slowdown, I do think, and especially from the retail investor point of view, there's a lot to potentially like on the AI play, especially with robotaxi and this humanoid robot theme.
Final question on the EV slowdown, Tom. Talk to me about the European OEMs.
Yeah, that's actually really interesting to look at. In Europe, you're not seeing an EV slowdown nearly as much as you do in the US. They have to sell these for CO2 compliance and regulatory. But that said, these companies are still losing money selling EVs. So that's why I'm actually more constructive on the US legacy OEMs. They get to sell pickup trucks and large SUVs. In Europe, fine, there is demand for EVs. It's not the same problem here, but remember, they have this Chinese threat. The Chinese OEMs are already in the European company's back door. They're already selling EVs cheaper. It's just a much more competitive dynamic there. So while there is EV demand, it's just really competitive over there. I really think you can kind of hunker down and look at the legacy OEMs in the US.
Tom, we're always lucky to have you on the show. Thank you for your time and those picks, sir.
Nvidia is set to report second quarter earnings tomorrow. Investors optimistic that demand for AI hardware remains high. Joining me now is Tony Wong, T. Rowe Price Science and Technology Equity Strategy Portfolio Manager. So Tony, we've seen tech stocks surge on this AI trade. Some are up 30, 50, even 100%. I'm looking at Alphabet. It's hovering near that record high. So is this momentum sustainable, or are we edging closer to bubble territory?
Well, I think there's a lot of dynamics going on. I mean, you have to look at the price moves in context with where we were in April. And so we had a big sell-off and now a rebound. Clearly, as it relates to Nvidia, like demand really inflected last quarter. And so I think what is going to be exciting is just like the continued progress of AI, how that's going. But if you look at like the numbers, I mean, this is not largely a market that's been driven by multiples, extent that we had in the dot-com crash. And so to me, it looks fairly valued, given the growth that you're getting with stocks like Nvidia.
Now, when it comes to Nvidia, the street already expects a really strong second half. What will really move the needle when these results come in? Do you think it's guidance for 2026 demand? Is it China risk or something else?
Yeah, I think in the near term, I don't think anybody is really concerned about demand for the rest of the year. I think demand continues to outstrip supply. It'll probably be more about the cadence of product delivery, how to think about 26, if anything, the growth there. And then also, the China revenues in terms of the timing of that. I think there's some noise in terms of, what SKU or what product they're going to order. But I think that's a little bit more short-term stuff. But over the long term, I think what matters is that, less competitively, I think is what the market's concerned about, but more the demand in 26.
Mm-hmm. Now, you did flag power constraints and supply bottlenecks as top concerns for the outlook here. How big of a threat could that be to Nvidia's growth story, especially as we look beyond 2025?
Yeah, I think that you're seeing a few companies over the last earnings season, talk about really strong demand, but perhaps like there are bottlenecks in power, or maybe there's a golden screw issue. And so, those things can happen when demand is outstripping supply. And so to me, those generally get worked through, but it is something that can create some temporary kind of changes in the supply. So to me, I think it's kind of a near-term concern, but over the long term, these things do get figured out, and they're not problems that are impossible to solve.
And what do you think of a company like CoreWeave? I mean, it's surged since its IPO, and then you also have AMD and some of those other competitors. Where do you think investors should be when they're playing the AI game?
Yeah, well, I definitely think that the market is closely watching CoreWeave. Essentially, they are innovating in this kind of finance, kind of backed by the GPUs. And so to me, that's kind of a tip of the spear demand in terms of NVIDIA's customer set. Not the not the only customer, obviously, but something that I look at, pretty closely to see how supply and demand are trending. And CoreWeave does have more of a clean sheet approach. They move really fast. So it's definitely an interesting player in the neo clouds, which we're seeing kind of be this new crop of customers for Nvidia.
And when we look ahead, there's been a lot of talk about what the next wave will be for AI, beyond just the chip makers and the hyperscalers, maybe even into some of those software players. Where do you see that ripple effect playing out?
Yeah, so I think there's a few debates going on. One is, over the past kind of 10, 15, 20 years, we've seen kind of software eating the world, and now AI is potentially eating software, and that's been a key debate here in the market. And, to me, I think about essentially a few ideas here. There's this idea that potentially AI augments software, and then, what you really want is these platform software companies that have data gravity. And at the same time, you have these large language models like OpenAI and Anthropic that are looking to, build a whole new set of workloads that potentially you don't need to upgrade your legacy software for. So I think that's the kind of tension that we're looking at. The second thing I've been thinking about is just this cost of intelligence potentially going to zero. I think we see this every day in our usage in ChatGPT or Grok or name your large language model. But what previously might have taken, somebody with a PhD, multiple hours, you can almost get 80% of it, and the results are getting better every day within 5 or 10 minutes, perhaps. So I think that's going to be an interesting element where creativity is really going to be leading in the market, and it's going to be like a best idea wins.
And do you have any specific names that you can reference when we talk about some of those best ideas?
Yeah, what I'm looking at in some, what I think is interesting is you want to invest in the platforms, I think. Platforms that have really interesting technology and then also kind of a physical infrastructure into the world. So, large language models, they can think, but, you also want to act. And so I think that's why the market likes Tesla. Like they have tremendous technology, data, robotics, autonomous driving, other ideas that companies that I watch is like Carvana. When you think about, they have a great platform and they are reconditioning cars at a lower cost and passing them on to consumers. Like, can they do something to supercharge their business and platform the AI? Axon, for example, they're using kind of the AI in Draft One, like helping police officers fill out paperwork a lot faster, and then also using drone technology and integrating that with their whole platform. So I think there's a lot of really interesting companies right now, and it's definitely, I think, probably on the early side of AI and not the later side.
We've been talking a lot about the market rotation out of some of these big tech names into some other undervalued parts of this market. What's your view on that? Do you think the market will still be held up by these mega cap companies?
Yeah, I think that's probably what the market's been struggling with over the last few weeks. I mean, look at the moves, some of these relative moves of the AI winners versus what the market has suggested to be the AI losers. I mean, there's like 50 to 100% moves over the last few months. And so here it's kind of like, okay, like what could be oversold and overbought? And in some ways, like we are going through a lot of cyclical pressure. You think about rates are super high, the cost of capital is expensive to companies to make capital investments. And so, I think that the market can sometimes put a narrative on the numbers. And so as a result, perhaps some of this stuff is just cyclical, and therefore the market can put a higher multiple on some of these stocks that have really lagged.
All right, Tony, thank you so much. Appreciate it. And a programming note, tune into Yahoo Finance tomorrow after the market close for full coverage on Nvidia's earnings results and our live sit-down interview with Nvidia CEO Jensen Huang. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst. First up, President Trump looks to oust Fed Governor Lisa Cook. We break down the market implications and the historic legal battle ahead. Plus, we'll sit down with the former president of CNN to discuss the state of the media industry. And we hone in on the retail sector and how tariffs are impacting businesses and the consumers with back-to-school shopping in full swing. 90 minutes into the start of U.S. trading, I'm Allie Canal. Let's get a check on the market action. And taking a look at the major averages, we're seeing the S&P 500 and the NASDAQ trading in the green. The NASDAQ pretty firmly in the green there, up about 0.2%, where the S&P is hovering around that flat line. The Dow is also just below the flat line, off roughly 27 points. Well, President Trump's attempted firing of Fed Governor Lisa Cook is shining a spotlight on February. That's when key terms expire. Yahoo Finance Washington correspondent Ben Worschel has more. And Ben, we're only about 6 months out from that February date, that deadline. How real is that threat that Trump could use these expiring terms to fundamentally reshape the Fed?
Yeah, so this is what we appear to be setting up here is kind of a two-stage battle in the months ahead. First is this immediate term question of whether Trump can fire Lisa Cook. That's clearly going to court and is going to be contested over the coming weeks. And then there's this February deadline that you mentioned. That is when the regional Fed presidents' terms expire. They have 5-year terms that are usually kind of a non-event. February on years that begin in 1 and 6, the Fed presidents are largely renewed usually, but there's going to be a lot more focus on that, especially if Trump can succeed here and install 4 allies on the 7-member board of governors. Basically, these regional presidents are chosen independently, but they do have to be approved in Washington by this 7-member board. And if there's 4 Trump allies on that, there could be a lot of questions about how that goes forward for these 12 governors, or these 12 presidents, excuse me, around the country. They make up 4 seats on the Fed each FOMC meeting, so they have a big say in interest rates, and this is going to be a question here. There's some skepticism about whether there could be presidents could not see their terms renewed, but there's clearly going to be a leverage point here for Trump and his allies, not just on the 7-member FOMC, but this wider universe of Fed presidents.
So, Ben, what's been the reaction this morning about how likely it is that Trump's allies might try to take this unprecedented step?
Yeah, there are reasons for caution that we would see this kind of firings aspect here, because this would truly be uncharted territory for the Fed and would be a real break from Fed traditions. Even Trump allies on there, it seems like a stretch to suggest a figure like Christopher Waller would advocate for sort of scraping clean all the 12 Fed regional presidents. But it's clearly going to be a point of leverage, and Trump has shown that he will keep going further than most people expect. I think the firing of the attempted firing of Lisa Cook today is a step that people weren't expecting, and so he's clearly aiming to push interest rates lower in dramatic fashion, much faster than Jerome Powell is going to. So he's gonna use this point, I think, for certain. How far he goes, I think there's a question, and there's some question about whether Trump allies on the Fed will accede to his wishes to go hard on this.
Yeah, certainly a lot more questions to be answered. Ben, thank you so much for tracking it this morning. All of your market action straight ahead. Stay tuned. You're watching Market Catalysts. President Trump blasted NBC and ABC News in a post on Truth Social, calling for the FCC to revoke their licenses over what he called unfair coverage of the Republican Party. Current FCC Chairman Brendan Carr has already launched formal reviews of nearly all of the major networks. With more on what the president's threats mean to the broader media landscape, I want to bring in John Klein, former CNN U.S. president and CEO of Hang Media, alongside Matthew Dolgan, Morningstar senior equity analyst. Thank you both for being here. John, let's start with you and Trump's latest salvo. He's threatening to revoke those broadcast licenses from ABC, NBC. From your experience running CNN, how seriously should we take this, and what would it mean for both journalism and the business of broadcast news if the FCC were to act here?
Well, not to be too flippant about this, but I think that the networks should be flattered that President Trump may be the last person in America who feels that they are relevant anymore. So it's a compliment in a way. You know, the truth is that there are so many sources of news and information and opinion. Chris Christie, who appeared on ABC, which is what stoked Trump's ire the other day. Chris Christie doesn't need to go on ABC News and be interviewed by Jonathan Karl in order to express his point of view. And so, you know, it could become a game of whack-a-mole, actually. And when you think about all the storm around the Epstein files, that has not been driven by the mainstream U.S. news networks, it's been driven by all of those myriad voices popping up all over the place. Actually, the call is coming from inside the house in that case, if you're Trump. So, I think the bigger challenge for the network news organizations is also from within. They've been slow to acknowledge where the audience is. Most people, the vast majority of people 45 and under, get their news from YouTube or TikTok or other digital streaming sources, not from cable or broadcast news. And the networks have been very slow to acknowledge that. And that's what they've really got to come to grips with. They've got to pivot hard into streaming, and they've got to develop personalities who news consumers out there want to connect with.
Right, and it does seem like, though, the broadcasters are really vulnerable to some of this political pressure. I mean, President Trump just won a $16 million settlement against Paramount over that 60-minute segment that was cleared ahead of the Skydance merger. So what do you see from the media side of all of this, how vulnerable broadcasters are to legal and regulatory challenges?
Ultimately, the truth is going to be their best weapon. If they just focus on getting the facts straight, not going on a jihad, not having a preconceived notion about who's right, who's wrong, or what is going to happen and all of that, but actually just roll up your sleeves and do the real hard reporting. That's the best antidote to all of this. And that's, my friends in the industry who I talk to all the time, they understand that. And in some ways, it's helpful for them to remember, hey, be buttoned down, get your information correct. And if you're right, then that's the best defense against all of this.
And one TV broadcaster that's getting a lot of attention recently is Nexstar, owns over 200 stations, has a stake in the CW. It is pursuing a $6.2 billion deal for smaller rival Tegna. And Matthew, I want to bring you in here because you've been very bearish on this deal. You say that approval isn't a given. What are the biggest roadblocks here in your view?
Yeah, that's exactly it as far as us not thinking that approval is a given, because otherwise we're not bearish on the deal for Nexstar. We actually think it would be a great deal for Nexstar. We're skeptical that it has a broader read through to the media industry. But as far as your question on our skepticism on approval, it seems that the biggest hangup will be the current 39% cap on station ownership. So any company with owning local stations can only cover 39% of the U.S. population. There's a discount for UHF stations. But ultimately, if this deal were to go through, that number would be about 60% for the combined company. So there needs to be a lifting of that cap. The FCC is very amenable to that. They are looking to lift the cap. So we question two things. First, whether the FCC can unilaterally do that or whether it needs Congress. We think it very well may need Congress for a couple of reasons. It doesn't mean the FCC won't try to lift the cap unilaterally, and that would, in our view, lead to an extended legal fight. So we would see what happens there. We don't think it's out of the realm of possibility that Congress would lift the cap itself. We see pros why you would want to do that, even though there are some things that might make this look monopolistic for local stations. If you look at the broader media industry, local stations are not only competing with each other, and this would potentially be imperative for them to compete in the new media landscape. With that said, there are views on both sides in Congress, and it would be another thing to watch. And so we don't think the FCC can necessarily do it unilaterally, and we're not certain that Congress would be willing to lift the cap. And that's why we think, at the very least, it's going to be an extended fight on whether this gets approved.
And Matt, I'm also curious, with a lot more expected deals across the media landscape, do you see regulation becoming a headwind for the future, especially since we have Warner Brothers Discovery and Comcast Versant splits later this year?
So it seems it's such a difficult question to answer because you can't necessarily read through to what some of these governmental agencies are looking at right now. It's been well established that the reason for the Paramount payment to settle the 60 Minutes lawsuit might have been to help grease the wheels. So you never know, but it seems like regulations and regulatory hangups would be a little bit more lax. In our view, that's one of the reasons, and I don't cover Comcast, so I wouldn't want to speak to the Versant spinoff. But for example, Warner Brothers Discovery is spinning off its global networks from its streaming. In our view, one of the bigger reasons for that is to potentially look towards consolidation a little bit more. And so I do think that companies are thinking in this environment, despite the puts and takes, ultimately deals would be looked upon more favorably.
So, John, what's your reaction to all of this wave of consolidation? Do you see it as sort of this shrinking to survive mentality? And where does that leave a lot of these legacy broadcasters?
Well, it's inevitable that it happens given the change in audience behavior. And it's just smart business in order to figure out how to optimize the assets that you've got. That said, there's no shortage of outlets for information and opinion, thanks to streaming. And I think you'll now, especially with the advent of AI, which is going to power a tsunami of creativity and content, I think you're going to see even more sources. And the real trick is going to be making sense of it all. How do you separate the signal from the noise, so to speak? And that's where trusted personalities, individuals, not brands, but individuals who can attract an audience who's looking to better understand a world that's becoming more confusing by the minute.
Mm-hmm. And from the consumer perspective, it does feel like there's a lot of places that you can go to get your news. And you were saying how, the personalities, the trust, that is key. How are you looking at the viewer and what they're really craving and looking for right now?
I think, first of all, they want to know where to find this information. It's bewildering. I mean, think about when you settle in the evening to watch your favorite show on a streaming platform, just figuring out where that show lives. Is it Prime? Is it Netflix? Is it Disney? Is it right? So that's got to be simplified. And I think that's a big opportunity in the market for the folks who can come along and do that. And second of all, they want reliable information. I mean, Yahoo Finance is a great example of an outlet that you're not spinning it one way or the other. You're just telling us what's going on. And I think that is an untapped resource. When I was running CNN and we were faced with Fox on the right and MSNBC on the left, there was a school of thought that said we ought to go one way or the other and just get into the opinion business. And I always felt, no, we should be playing it right down the middle. And our differentiation in the market would be that we're supplying trusted information. And I think today there's an even bigger opportunity for that in the market.
Absolutely. And thank you for that shout out, John. John and Matt, thank you so much. Both appreciate your time today.
Thank you.
Well, coming up, some of today's trending tickers, plus why one CEO says execution is key to generative AI projects.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ. Let's get a quick check of the latest market action. We're about 2 hours into today's trading session, and all three major indices throughout this morning have been roughly flat, moving higher or lower. You see right now the Dow is moving lower. We also have the S&P 500 roughly flat, and the NASDAQ also moving a bit higher, up about 0.2% as we make our way into today's trading session. I also want to look at the latest movement on the Treasury yields. If you take a closer look, what exactly we're seeing there is the 30-year move higher, up about 0.7 points here. And really, we're looking out for the Treasury yield to move to that key threshold of roughly 5%, which could spell a bit of trouble for stocks here. Also know that right now, markets are trying to digest the latest headlines of President Trump potentially firing federal governor Lisa Cook. And if President Trump does succeed in that, that can have major implications on perhaps President Trump adding a more dovish policymaker. Investors are keeping a close eye on that. I also want to take a look at gold futures, because what exactly we're seeing there is gold futures moving just a tint higher, up about 0.2% as we make our way into today's trading session. That could signal that perhaps investors investors are looking for safe havens here right now. And all this market uncertainty, especially ahead of that key PCE report set to come out on Friday and ahead of the key September FOMC meeting, where largely markets right now are pricing in that there will be a rate on interest, will be a cut rather on rates. But keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout today's trading session.
Now time for some of today's trending tickers. We're watching defense stocks, AMD and Cracker Barrel. First up, defense stocks. Commerce Secretary Howard Lutnick opening the door to the federal government taking stakes in American defense contractors, telling CNBC the defense secretary is thinking about it. Joining us for more is Yahoo Finance senior reporter Brooke DePalma. And Brooke, we just heard from the government taking a 10% stake in Intel, so it seems like this maybe could be the norm here.
Yeah, largely what we're seeing there is this notion of the government largely teaming up with companies that they already do business with. And so, of course, we saw a rally for Intel. And now what we're seeing here is a similar market reaction across Lockheed Martin, Northrop Grumman, General Dynamics, as investors are excited about the potential implications that this could have of the government investing in these defense contractors. It's important to note here that Lockheed Martin, 70% of its customers are here in the U.S. And so this would essentially be an extension of the government already taking stakes in companies like Intel. And just keep in mind, this is largely unprecedented. We haven't had this before, but it's an ongoing continuation of what we saw just last week.
Yes, absolutely. Next up, AMD shares trending on the Yahoo Finance tickers page after the chipmaker unveiled a quantum-centric supercomputing partnership with IBM and got a rating upgrade to buy at Truist. And Brooke, AMD has just been on an absolute tear this year. It's up nearly 40%.
Yeah, in the last month alone, it's roughly flat. But if you take a look year to date, it's up nearly 40%. In the last 6 months alone, especially off that lows of April, the stock is up nearly 60%. And what we're largely hearing here is this excitement around that plan with IBM. It's important to check here. IBM shares, those are just roughly flat, up about 0.7% based upon this news. But largely, there's excitement around the implications that this could have. You know, the combination of AMD's technology with IBM's quantum computers, something that it's been working on for the past, say, nearly decade and more. And so there was no new products announced just yet, but certainly there's excitement about what this could look like and the future implications. And that's why we have AMD moving higher this morning, once again, up nearly about 1.25%.
Finally, Cracker Barrel. President Trump wading into the controversy around its new logo. Brooke, what can you tell us here? This seems to be a story that has really captured America's attention.
Yeah, from when the company announced this new logo plan, which was just supposed to be this minimalistic logo, focusing in, leaning into those colors, and taking away Uncle Herschel. They said that they still planned to keep him on the menus, but they were going to remove him from the logo, which is still in effect. President Trump now weighing in on the conversation after Donald Trump Jr. and one of his advisors have been weighing in since it was announced on August 19th. But take a look at what President Trump said on Truth Social. He said Cracker Barrel should go back to the old logo, admit a mistake based on customer response, the ultimate poll, and manage the company better than ever before. Now, Cracker Barrel did try to get ahead of this post. They did take to Instagram on Monday evening, and they did write that they could have done a better job sharing who we are and who we'll always be, leaning into the idea that the company was built on back in 1969, hard work, family, and a scratch-cooked food made with care. And I don't think that the company could have anticipated this sort of reaction, the backlash that they've gotten over the past just really 6 days has led to a 9% decline in the stock. But as you can see here this morning, after President Trump took to Truth Social, that stock now rallying up more than 4.5%, and it was up nearly 6% just a few hours ago.
Thank you so much, Brooke. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Ahead of Nvidia's earnings, all eyes are on the artificial intelligence trade. A study out of MIT found that 95% of enterprise generative AI projects failed to become profitable. Companies collectively spend $30 to $40 billion on these projects. But speaking to Yahoo Finance, Appian CEO says that AI is only as good as the work that you give it, and he doesn't see a bubble forming. Take a listen.
Yeah, people are talking about a bubble, but I don't think there's a bubble right now. I think when bubbles exist, it's because the value outstrips the price. But in this case, AI is just as valuable as everybody thinks it is. It just needs to be better applied. Back in the 2000 era, there was high valuations with no value underneath. AI is in fact extremely valuable. We just need to apply it correctly.
So what did you think when you heard Sam Altman of OpenAI fame? He suggested there was an AI bubble.
Yeah, he did. Well, look, he's using AI at a commercial level, right? And at a commercial level, funny thing is that's where a lot of the value is being seen. You look at that MIT report that came out a week ago, and what you'll see is that AI is failing when it's applied to enterprise situations. What we need to do is figure out how to get AI to be valuable. Now, I don't know whether Sam is right or what he's talking about, but I look at real AI applications. I see the use cases, I see the value created, and there's no doubt AI is incredibly valuable. We just need to be sure that everybody's using it correctly. Look, everyone in the world knows that AI is only as good as the data that you give to it. What they don't understand is that AI is also only as good as the work that you give to it. And we, as an economy, have applied AI to a bunch of silly side jobs instead of the core processes that make real value in big organizations. And once we learn to put AI in the right place, there won't be any question about a bubble because the value will be there.
You mentioned that MIT survey there, and just to put a point on it there, Matt, what it said was 95% of the organizations studied were getting zero return on their AI investment. I mean, that made a lot of headlines, that got a lot of attention, and for good reason. Well, what do you make of that? What explains that?
I think that was a really smart report, and I think that it needs to be read and taken seriously. I see it as one of a few warning signs right now about the state we're in enterprise AI. I would add to it the fact that AI has plateaued over the last year or so. ChatGPT 5 seen as a bit of a disappointment, that there is convergence between AI technologies, so all the models are performing roughly equivalently. Was it Robert Solow, the economist, said you could see the computer age everywhere, but in the productivity statistics. Well, the same thing is true right now for AI. You see it everywhere, but where's the productivity? And AI, the MIT study really brought that out and showed us that we're using it in the wrong way. I think this is the end of the beginning. What we've got right now is the end of the beginning. It's the end of the period in the evolution of AI where you can talk about it merely for its potential alone. That's no longer okay. And these warning signs that are gathering around us and threatening us to think in bubble terms, they're really a signal that the beginning is over, that we need to move into a phase in which AI is evaluated according to the return on the investment that's being made. And $30 to $40 billion have been spent by major enterprises in AI projects. And as MIT points out, 95% of those are not showing a return. We need to reevaluate the way we're applying AI.
Let me get more specific, Matt. How are you all at your company? How are you leveraging AI?
Oh, well, we provide the missing link between AI and the workflows that allow you to apply AI to real work. All right. So AI is only as good as the work you apply it to, and it's time across our economy to put AI into play in real work, not the side jobs, but the real work. And that's exactly what we do. We apply it in the framework of a process or a workflow, and the MIT study talks a lot about how AI has got to be in workflows in order to be valuable. That's exactly what we do. We put AI into a workflow so that it can address the complicated actions that big corporations take that provide real value within the system. I'm talking about things that happen thousands of times a day, things that are handled by a complex interchange of people and machines working together in a coordinated fashion. AI today has not been a part of actions like that, but it needs to be. That's where AI can create the greatest value. And it happens to be that Appian software does coordinate AI into real work in that fashion. But that's what everybody needs to think about. Whatever their vehicle is for getting AI involved in real work, that's what everybody should be thinking about now.
Let me ask you, Matt, since I have you, I'm just curious, the macro tariffs, have you seen an impact there on your business? And in terms of, Matt, the time to get deals done, the size of deals?
Yeah, we have not seen impact from the tariffs. Now, I wouldn't have expected us to, right? Because we don't have a lot of inputs that are going to be tariff adjusted. So the only way that we would see an impact from them as a software firm was if the uncertainty or the burden were affecting our customers to the degree that they were canceling or delaying major decisions. And what we've got right now, we're riding a tiger. We're in a revolution right now where everybody wants to make value with AI. And the MIT study points this out. They say there's no reluctance. Everyone wants to bring AI to the point where it's creating value in their institution. And so we're actually doing fine. We had our best quarter in years last quarter. We're showing the momentum. We're charging more than 25% uplift to put AI into a process, and we're getting it. We're able to show the revenue and the margin from AI, and it has not slowed down as a result of the tariffs. But I think that's because there's just worldwide demand for this, and we're not under the gun for any tariffs directly.
Matt, always good to see you. Thank you for your time.
Thank you, Josh.
Deals are back, and this week, Keurig Dr. Pepper unveiled an $18 billion bid for coffee maker JDE Peet's, and global M&A activity has already hit over $2.5 trillion this year. But what's really behind a merger, an acquisition, or even a bankruptcy? On today's Stocks in Translation, we're going to turn headlines into your playbook, and we're going to break down what happens to your shares of a company when a big deal is made. Now, to begin with, we're looking at three different types of corporate deals. We have going private, then merger or acquisition, and finally, bankruptcy. We're going to ask the same questions every time. What do you get and what do you do? So now let's open door number one, going private. This is when a company, a public company, is bought and leaves the stock market. Holders are paid in cash at a set price, and trading ends when the deal closes. What you see is a limited time invite to sell your shares, called a tender offer. It has a set price, and if too many people accept, you just get a partial fill. If you own the shares, you're going to be notified, but pay attention to the deadlines to make sure you get what's coming to you. A great example is Tesla. Remember 420, funding secured? That was the 2018 going private talk when Elon was dropping hits about taking Tesla private with Saudi money. Never got off the ground, but the mechanics are exactly this: a cash number, a clock, and a choice. Now behind door number two, we have a merger or acquisition. It's when another company buys yours, and you might get paid in cash or stock of the buying company. What you see is a merger announcement and the shareholder vote. And if there's a choice to be made, you vote. Sometimes you can elect cash or stock. Sometimes you just have to roll with the punches. In cash deals, you're going to get cash. And in stock deals, you get shares of the buying company. Sometimes it is a mix of the two. And make sure to watch out for what's called the record date, which is the cutoff for the votes that gets to vote. Also, you're going to want to watch out for any election deadlines. A recent example is Microsoft buying Activision Blizzard. Mr. Softy, or Microsoft, announced it in 2022, then closed it in 2023 at $95 cash for Activision shareholders. Since they were cashed out, they did not get Microsoft stock. Now, finally, behind door number three, guess what? We got bankruptcy. Real quick, there are two different types. Chapter 11 reorganizes a company and often cancels old common shares. Then you have Chapter 7, which liquidates the entire company, and common shareholders are usually wiped out totally. What you see is a notice of either a Chapter 11 or 7 filing, and sometimes a ticker gets a little Q at the end of it. It's kind of like the scarlet letter for reorganization. And if you get access to this new bankruptcy ticker with the Q, your broker is going to show it automatically. Usually there's little or nothing for you to do. And some people trade the Q ticker in the over-the-counter market, but be careful. It's very volatile and tied to court decisions, so traders are warned. Also, watch out for what's called a plan approval, which is a court sign-off, and the cancellation or effective date when old shares officially disappear. Famous example is GM's Chapter 11 bankruptcy over the global financial crisis. The shareholders were wiped out in 2009, and this max chart on your screen shows that trading started all over again with a 2011 IPO. Now, here's a rapid-fire reality check in our final shareholder showdown. In a cash buyout, you're going to get cash in a stock swap, and you also get shares. And remember, sometimes you can get both cash and shares. And then in bankruptcy, there's really not much of a deal to be made with you, as you're likely not going to get anything. Bottom line, remember to always look out for those shareholder notices in your email or physical mailbox. And anytime you get cash, guess what? Uncle Sam is probably going to take a cut in taxes. New shares are often tax deferred, but when in doubt, always talk to a pro. That's all for today. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts.
Some breaking news crossing the wire. Federal Reserve Governor Lisa Cook will sue over President Trump's push to fire her from the Fed board. Cook's lawyer saying in a statement that President Trump has no authority to remove Federal Reserve Governor Lisa Cook. His attempt to fire her based solely on a referral letter lacks any factual or legal basis. He says they will be filing a lawsuit to challenge this, quote, illegal action. The latest update comes after President Trump moved to oust Cook following allegations that she falsified mortgage documents. In a letter posted on Truth Social late Monday, Trump said he had sufficient cause to fire Cook based on the allegations from a White House ally that she made false statements on one or more mortgage loans. Cook was defiant, saying that Trump has no authority to fire her and that she will not step down. The news moving asset classes, including longer dated treasuries, gold, and the U.S. dollar. Well, for the nation's retailers, a lot is riding on back to school and holiday shopping. But new data indicates consumers are growing wary about opening their wallets. The Conference Board's Consumer Confidence Index falling in August to 97.4 as Americans cited tariff and job concerns. Stephen Yavlov, Tanger Outlet CEO, told Yahoo Finance is asking for a trend that up to now the stream of shoppers has been steady.
If you go back to tariff announcements in early April, traffic's continued to build. So built in April, May, June, July, and didn't stop in August. We see cars in the parking lots in our shopping centers. We see people spending. And it's kind of interesting, sort of sounds a little contra to, to the storylines that are happening out there. But it's, especially in the value space where we have most of our shopping centers, that's where we're seeing the customer lean in a little bit more heavily.
For more on the outlook for retailers, I'm joined here on set by Jessica Ramirez, the Consumer Collective co-founder and managing director. Jessica, thank you so much for joining us. So we did see consumer confidence slip once again in August. From your perspective, how are consumers balancing higher costs while also making sure that they're shopping for essentials like back to school?
So I think earlier in the year, we did see the consumer pull back. They did a pull forward once they heard the announcement of the tariffs. Then we saw savings actually go up. And I think in terms of that, they started budgeting a bit more of, we know we have back to school, we know we have holiday, let's save up and then start using again. So we started seeing a lot of the shopping come through in June, as early as June, July. And that Prime Day that we had, those sales were really good across the board. And we saw a big which we hadn't had from like Prime Day. So I feel like a lot of the consumer there, they decided to spend ahead of the second half of the year where prices are likely to increase. So again, we've seen a pull forward, a very shaky consumer overall, and also just shopping towards the need. So if you think about grocery and staples, shopping for that first and then budgeting where the rest needs to fall in.
Considering that pull forward effect, does that worry you when we look out to the fourth quarter potentially?
To an extent it does. I think there's a difference with retailers. So if I look at how they're willing to perform, I feel that they do understand how the consumer is shopping and they're leaning into categories that the consumer is interested in. So we talk a lot about beauty, and I think beauty is going through a shift. Skincare is still doing really great, but that shift, and we'll hear more from Ulta this week, but if we think about beauty, off-price is doing really well with beauty. You also have Target, you have Walmart, you have K-Beauty, you have Sephora doing doors. So that's why there's a shift, but all these retailers leaning into that. You have sportswear doing very well. The viewership is up, participation is up, all the sneaker brands have done extremely well. All their numbers have been up. So the consumer is spending there. So you see more spending on that. Where we see pullback is apparel that may not necessarily have a purpose. So I think we'll hear more about that this week with Gap and Abercrombie and Urban Outfitters, although they're leaning into trends such as denim, which, for back to school, we think that's going to do great. Holiday as well. So it's more of a balancing act where we're seeing how is your inventory performing and how are we not actually promoting and where can we put that price hike rather than not.
When we look at some of those off-price retailers like TJX, like Ross, are we seeing the consumer continuously look to trade down so they can find those better deals?
So we do see, and last week they had great performance on their end, and they are very well situated. TJX, and the last time when we had a recession, they positioned themselves very well. They've continued to gain. Ross, again, in terms of inventory, they have much better, stronger brands now. So again, really well positioned there. I think the consumer is looking to trade where it needs to. However, I think the question of value has changed. So it's not necessarily I'm buying something because it's cheaper. I'm buying something because I want quality. I want, if I'm going to spend that extra dollar, that extra $10, is that actually going to last me longer in terms of longevity? And so again, we have like Coach doing really well. We have Ralph Lauren doing really well. Levi's. These are all very trusted brands that are steeped in heritage. And the brand knows that, and the consumer knows that. So is my leather product going to last me, until next year, and maybe I just accessorize it, and that's how it makes a difference. So it's almost the psychology of how is the trend going to develop, and who can do it the best. But I think quality is definitely a key word in today's environment.
And I want to go back to something that you mentioned when we first started talking, and that was that the consumer is shaky. It is interesting to see, though, that the consumer is still spending, especially in categories like beauty, which I would maybe consider more discretionary. So what makes you sort of hang your hat on this description of the consumer as shaky?
In terms of beauty, it's an easy buy. It's an easy luxury. It's easy to feel nice about it. And I think what a lot of people forget in this category, it's an emotional category. So I shop for something that's gonna make me feel nice, even if it's the tiniest thing. It might help me open into a brand. I was just actually at Sephora, and it was 9:55, there was people outside. And at 10 a.m., everyone went in and was getting their items. Again, it's a quick buy, it's an easy. And I think just the way the beauty category has been changing and the way we see beauty is different. So skincare is very important today. How can I look not aging when I'm 50? And even if that price is larger, I might actually bet on that, and it's replenishable. So for a retailer, that's fantastic. The customer's gonna keep coming in. So again, that's where I think we're seeing the beauty shift in the market, because many retailers are leaning into that where they hadn't before, and it's changing where the customer is going. So that's where my bet is. And the same with sport. It's why we really do like that. The customer feels good physically, mentally, emotionally, and they're betting on that. There's a lot more of community that gets built into sport today, and I think that's another address that we're fixing there.
Well, look, I know when I walk into a Sephora, I walk out spending way more than I initially intended to. So I understand that. Jessica Ramirez, thank you so much.
Thank you.
It. Well, that's it for Market Catalyst. I'm Allie Canal. Thank you so much for watching. More Yahoo Finance straight ahead.